I am a Tepper alum, absolutely love the program, try to stay involved and give back any way that I can. The community and the network that I got out of being a Tepper student has benefited me throughout my career and will benefit you as well. So please look me up on LinkedIn, shoot me a note, come chat with me after the talk. I'm available. What we're going to cover today is really the process for prospecting, identifying, and conducting outreach to investors. So anyone associated with a company that's done fundraising has absolutely heard this quote before. Great company, awesome company, love what you're doing. Not the fit for us right now, but keep at it. And sometimes, that's sincere, and other times it's being polite. But what we're going to go through today is in the effort of minimizing the number of times that you're going to hear that. So what we're going to cover is finding the right fit. That both involves profiling yourself and your company. Who are you? A little bit of self-discovery, and then finding investors that are the right fit for your company. In the normal course of that process, I'll just hit on what it is investment bankers do and why people hire investment bankers. And then what non-technical students can do to help startups. That's a question I get on campus all the time. I'm interested in working with the startups here in the Swartz Center, but I'm not a coder. And if I don't code, what the heck is it that I can do that's of any value? What we're going to cover today, every single company in Project Olympus, in the Swartz Center, and Innovation Works, and Alpha Lab, associated with Carnegie Mellon, every single one of them needs this. It's of great value, and you have the resources at your fingertips to do it. A lot of it is just time and effort, and that's something non-technical students can do of great benefit for startups. So that's what we're going to cover today. Let's keep it conversational. So if you have any questions, just raise your hand, call it out. Anything pertinent to your company, let's chat about it. If you take only one thing away from this whole talk, it's to contact Ryan Splenda. You have hundreds of thousands of dollars of database resources that for free, you've already paid for them, so you don't have to pay more for them, available for you through the library. And it's part of Ryan's job to help you use those databases and show you how to use them and make sure that you're getting the most out of them. This is not something that when I was a student, that I found that they taught in any class. And when I found out about it, quite frankly, it sounded like a cheat code. I was like, oh my gosh, the librarian helps you do your work? Who knew? Apparently that's what librarians do.
Make sure to understand what would be like Crunchbase or PitchBook and stuff like that.
Exactly, and I'm going to list them out. Bingo. The exact things that once you leave this university, you have to pay an arm and a leg to get access to. A new resource, which is also pretty exciting. The Swartz Center now has a dedicated librarian. I presume Robin to Batman. So you now have two dedicated librarians just to help you do the exact things that we're going to cover today. So I said, if you take one thing away, it's Ryan's contact information. Jimmy's contact information would be the second thing. This is the list of resources that you have available through the library. Each one of these costs about $100K if you're not associated with the school. And like I said, you're already paying for them. I'll cover a handful of these examples. They all have their own strengths and weaknesses. And I will say that they all pull information more or less from the same sources with, call it 70 to 80% overlap. So if you do a search in CapIQ and you do a search in Data Monitor and the results are going to be mostly the same, but not entirely the same. So it is worth, if you're going deep, to be a bit redundant, because you never know, which data point's going to be the one that hits. That's a homegrown success story from right here in the same building. All right, we're working. So some of the info that you were able to look up here, who are the investors that participated and when they participated. Note that you're going to hear me repeat over and over and over again is it's not just the investment firm. It's important to know who the individual investor at the firm who led the deal is. Investments are made by partners and directors, not by firms. So if you look over on the right side, you'll see who the lead was at each individual investment firm. So you see Carnegie Mellon is on there, as well as a group of venture capital firms. Their seed round was led by True Ventures. You get the lead partners on the deals. They're co-investors. The amount the company has raised, its pre-money valuation and its post-money valuation, all pretty valuable stuff to compile. These are the same steps that you go through to put together a comps analysis. So when you say, hey, we have this much revenue, we're growing at this rate, this is the industry that we're in, and you go talk to an investor and you say, Mr. Investors, I'd like 50, 10, $5 million. How much of my company am I going to sell? What's the value of my company? Those investors are doing this exact work. They're generally going to come to the table armed with more information than you. They're going to look at companies comparable to yours and what valuations they raised how much money at. And you put together a dozen, 2 dozen of these. You look at the averages, the means, the spread, and you can start to triangulate around what the most market valuation is today for that company. Anyone who's raising money should go through that exercise as well. Exact same steps as we're covering today. Just add some more columns to your spreadsheet and start collecting this valuation information. Other very applicable terms that you can find. Now, Sully has a lot disclosed because they're bought by a public company. But you can also see here that their rounds included a 1x liquidation preference, which means that those investors got their money off the top of the sale and then participated. Oh, non-participating. So that went against the return. Or, a participating round would then be, they then full participate in the liquidity after they already recouped their entire investment. But they are collecting a dividend, which means they're clipping an annual coupon. You're paying them just like you would pay a bank loan every year. So these are other terms also important to know. When I'm negotiating investment terms, advice I often give to founders, people get distracted by the headline number. I'm going to give you this big valuation. That's exciting. You work so hard for it. Valuations make headlines. But then people can chip away at it with terms. So multiple liquidation preferences, participation, and dividends. That's all coming out of your pocket. And at the end of the day, what you get to keep from your exit is as much or more impacted by the terms as that headline valuation. So other handy info that you can get out of these databases if you're preparing to raise funds. Look at a couple more CMU examples. A lot of what we're doing here, in addition to identifying the investor at the investment firm that led or participated in the round, those are ultimately the people you're going to go to ask for money. But we also have to map our way that we're going to get to those people. So how do we work the network? So I'm going to highlight Randy here. Randy was the lender on this acquisition. So if you can't find a path to Elizabeth at Featherling Hill Capital, maybe you can find a path to Randy because he's participating in the deals as well, just from a different angle. So it's, and I'll hit on intermediaries in a moment, but it's important to look at everyone who's participating and then work your network to find a path. When profiling investors, good investors want everyone to know what their investment criteria are. And you should pay attention. There's a reason they're telling you what their criteria are. They typically focus on certain size, target industries often because that's where their experience is, or they have an investment thesis there, and then company traits. And we're going to look, that's your growth rate, how profitable you are, where you're located. We're going to look at these criteria and then compare it to our own company. You may be surprised at the number of people that do outreach to investors who have tried to make it plainly known that I do not invest in your industry and I do not cut checks the size that you're asking for. I don't know why you're reaching out to me. That's wasted time on your part as well. We're trying to, and that's, when you hear, hey, you have a great company, but it's not a fit for us. So that's in part what we're trying to avoid. Industry Weapon, rebranded as Spectrio, another great CMU company. See some familiar names on here. Ed Engler has a conference room named after him in the back here. So if you see Ed's name come up and you're like, oh man, like I wonder how I could get introduced to these investors. The Swartz Center could probably help you do that. You might even be able to schedule a meeting in Ed's conference room. He's a great guy. Encourage you to talk to him. Back to my note about intermediaries, though, if you can't get to Ed, the fine people at Tepper Hamilton or Morgan Lewis, both upstanding law firms here in town, would certainly be happy to help make those introductions, or your accountants at Schneider Downs. Meridian's actually no longer part of the firm. They've broken out on their own, but the point still stands. So again, work your intermediaries. There's lawyers and accountants, more than anyone would like, and bankers involved in every deal. But one of the things we're there to do is provide that connective tissue and hold things together. Peptologics, another example here. You're going to see some familiar names here. Pittsburgh Life Science Greenhouse, Idea Foundry, Blue Tree Angels, LifeX, awesome group here in town. If you haven't spoken to LifeX, the diagnostics tools company, Kelly is an awesome CMU alumni, great person for you to talk to. And then you kind of work up your stack, and now you have Peter Thiel on here. So the earlier stage investors can often be intro path to your later stage investors as well. This was a fun company, won the McGinnis competition here, and then shortly closed a seed round afterwards. Something I'd like to highlight to my earlier point, it's not always through these traditional sources that you find information about the deal. If it's a super applicable deal to you and you're like, man, this company rhymes with my company, and I'd like to see who was involved and talk to those people. Sometimes you find it in press releases, you find it in analyst reports, you find it on Twitter. And to my other point about it's not an investment firm that makes an investment, it's investment partner or director. This firm does not publish anywhere that Allison Lechner led the deal, but I did find it in their Twitter announcement on it. There's a very, very typical format for deal announcements. Investment firm says, we're so happy to invest with the company, and they'll have a quote. The person they quote is the person who led the deal all the time. And then you have a quote from the CEO saying, I'm so happy to work with investor. And sometimes they let the bankers also chime in and say it was so great to work with everybody. You can't read this, but this is the pool of Carnegie Mellon investments out of CapIQ. So a fabulous resource that you have available to you is the alumni network here. So I've been doing this for a few years. I don't really trust this CapIQ number. I've pulled it in years past from other sources, pitch book last year, I think I got, around 100 companies that Carnegie Mellon and Carnegie Mellon affiliated funds have invested in. This is to highlight my point that these companies source information from the same sources, but the presentation has varying accuracy. So CapIQ is saying there's 32 investments. That's a little different than what I got for PitchBook. So, check multiple sources. But point being, those companies then have co-investors. And investors tend to invest with the same co-investors over and over and over again. Why? Well, you probably have similar criteria. And two, you've had experience with each other where you say, man, I've been on the board with this other firm and they stepped up when things got tough and they behaved themselves and they didn't do anything shisty. I would like to continue to co-invest with these guys. They were great. When you work with investors, you're kind of getting married. And like, any relationship, it's easy to get along when things are going well, but inevitably, companies are going to hit rough patches, and that's how you find out who's really on your board. So you go through a couple of those cycles and you start seeing patterns as to who likes to co-invest with who and who gets along. But in the rank hierarchy of introductions, there's none better than a repeat co-investor. So through your CMU network, you have access to all the people who have participated in all the CMU investments, and that immediately out of the gate, you have 92 investments, and then each one of these is going to have 5+ co-investors for each firm. This CMU company had 19 different investment firms invested in it. So you're starting with a source data set of about 100 investments out of Carnegie Mellon, multiply that by anywhere between 5 to 20. And that's a pretty good starting point if you're trying to think, who are the investors that I have access to? And sometimes you get guys like this fella who's an alumni and a hyperactive investor. So you can also identify some folks who are hyper connected and can really provide a multiplier. So if you have a connection here, he also has 38 other firms that he's co-invested with over the years directly. These are also good nodes to get into your network. So that's generally the tools that are available to you. I'm going to get a little more granular as to like how you perform these searches and what you're looking for and what the criteria are. But I'm going to pause just for a second before we keep moving and see if anyone has any questions or comments they want to bring up. Is everyone tracking? All right. So key steps here. Identifying comparable companies. When you think, well, what investors want to invest in my company? The easiest way to identify those investors is to identify companies that look, rhyme, smell like your company and who invested in them. Then we're going to go through making contact, what it takes to make contact, what materials you should have prepared in order to make contact, and the process, for doing that. When we talk about comparable companies, the way investors think about comparable are through these criteria. So these criteria should look pretty familiar. They're things that the investment firms we just covered had highlighted as their investment criteria on their websites and their profiles. But it's your industry. Again, they're going to have some sector experience that guides that. Target market, subsector of the industry, end market. It may not be e-commerce, robotics, or apparel. Their expertise might be serving women as an end market, serving middle market, retail businesses as an end market. That might be their experience. Company stage, pre-revenue, Pre-earnings, you're still burning cash, but you're commercial, you're scaling, and new balance sheet capital is really spent on sales and marketing. Those are pretty important, steps that investors divide along. And then the investment size. And investment size is also correlated to fund size. Typical investor, you're going to see having roughly 20 portcos. Any initial investment, they often hold up to 3 times that initial investment in dry powder and reserve capital for follow-on investments. So when you're taking money from anyone, that's an important question to ask, is how much dry powder, how much reserve capital do you have, and will you set aside for my business? A key role of board members. So anyone who's going to sit on your board, big question, why are you sitting on my board? The answer is to bring more money into my company. The advice is great. You can get advisors to do that. The real base answer as to why someone's on your board is because they're going to pony up more dough after the first check, and they're going to bring in other people who are going to pony up dough. So if you have someone on your board who's not going to cut checks in the future, and they're not going to bring in other people who are going to get checks, you really got to wonder why they're on your board. And because they're cutting that first check is not the right answer. And then geography, which is becoming less and less applicable over the years, and now is kind of more just international versus domestic. But
I was actually going to ask about the geography. So a lot of the CMU companies, let's say they start here, they might start with an angel investor or like a local VC. What's your experience seeing them? Have you been seeing a lot more companies leaving the Pittsburgh area and then starting, I don't know, Series A in the Bay Area? Or is that something that the initial investors don't quite like? What do you hear here?
Yeah, so Pittsburgh has a quirky dynamic in that our investors and our companies, I think this is getting a little less so in certain niche markets. If you're a robotics company or you're an AI company, we stand pretty tall. But I'd say for the most part, there's this sentiment here that people in Boston and San Francisco must know things that we don't know here. And a lot of companies will find it hard to raise follow-on capital locally. So they'll go to Boston, get a check, come back to Pittsburgh, show off their check from the very smart people in Boston, and then you can quickly garner a lot of follow-on investment locally. So there are companies that have been more or less exclusively funded locally through the later stages when their capital requirements really get bigger than what our local network can offer. And that's when you do see outside firms flying into town. But you also see people going out of town early on, almost for the stamp of validation. I don't think there's a lot of good reason to it, but it is been a pervasive dynamic in our investment community.
And if you're going to be recruiting talent, right? I mean, obviously, the marketing Boston, marketing in San Francisco is going to be bigger. So it might be easier for you to scale up or get more talent to join your company. Maybe not in the very early stages, but to scale, right?
You're also competing with more people for talent. So I will call a difference to getting investment from one of those cities to hiring employees in one of those cities. You don't need to have a physical footprint in order to get investment. So these are CEOs who are going on a road show is what it's called. So you're traveling around, you're meeting with investors. That's more or less completely disconnected from, hey, where your physical presence is. I actually think that Pittsburgh benefits a little bit on the employee front, and this has been an interesting dynamic to see over the years. As Amazon and Google and Apple and Facebook have set up big operations here, we have attracted a lot of pretty top caliber talent who has the incredible privilege of coming to Pittsburgh, joining a startup, giving a swing at it. And when I talk to these folks, I'm like, so what, this is fairly new in the last decade and a half. What made you comfortable moving your family to Pittsburgh to work at this startup? And often they say, oh, well, if it doesn't work out, I'll just go work at Google. Pretty great, backup plan. But we needed those companies to build, sizable operations for us to be able to do it. So we have a lot of benefits, much more affordable, semi-livable city. And, pretty big enterprise scale tech companies to offer that backup. Of the resources I covered, so, often a hard part of this whole process is just getting the ball rolling, getting started. So you're like, all right, so I'm going to look for investors who have invested in companies that are comparable to mine. Well, where do I find companies that are comparable to mine? Other than a Google search. CB Insights, I find, is like a pretty good place to start, get the idea juices flowing, get the ball rolling. They put together market maps in pretty, niche markets. I mean, they go far and wide here. So you have typical ones, we'll cover like online fashion, quantum computing, pharma startups, poop tech. It's apparently a robust niche, enough to have its own market map. So I highlight CB Insights as a good place just to get the ball rolling. This is an example of their market maps. So, clothing retailers, and they break it out into the different segments. So you're gonna, see examples of other logos that fall into your segment. You can pretty quickly look up the investors who invested in that segment, which companies within that segment they invested in. So not just the total number of investments that firm has made. Occasionally, investment firms will make a one-off. You kind of want to find the groups, these are stack ranked by number of investments they've made in that subsector. So who's really deep in your sector, who's super active. And then you can go, one deeper cross-reference. So upfront ventures, investments in fashion, which investments did they make? So it's a pretty good resource just to get the ball rolling and identify that first layer of comparable companies and who the investors were and what other applicable investments did they make and who invested in those. It's a little bit like going down a Wikipedia rabbit hole. It's very iterative. You're pulling a thread that's going to lead you in a loop, and then you're going to do it again. This is, and the reason I have this slide in here is the numbers on this page don't match the numbers on the prior page, but they're both from the same source, from CB Insights. So again, take all the numbers you get with a little bit of a grain of salt. They're more or less reliable, but not always. Another resource I'm going to highlight in an interesting dynamic. Dave finds this incredibly frustrating. I find this incredibly frustrating. You will encounter investors who try to be secretive about their source of funds and who they are and what they're doing. Contrast this with Elizabeth earlier in the presentation, who put all of her information on the homepage of her website. Good investors want you to know what they are trying to invest in so that you can come to them and tell them that your company is very applicable. Break Trail Ventures, there's no information about who they are. They invested in a Carnegie Mellon company. And oh man, even as secretive as you want to be on your website, that darn SEC still has disclosure requirements. So sorry, Jay Hirsch. I can find you by going to the SEC at your database and looking up the Reg D filing for the investment that you made. So I don't know why people try to be secretive about it. The regulators are going to require the disclosure anyways, but it is something that you run into. You can also see that Jay intended to raise $20 million. The filing was updated to show what he had raised.
The company, like, how should you interpret that when one doesn't make information like easily accessible about what their mission is and things like that?
I would make a mental note with an asterisk there, and just be like, okay, like there's something funny. It may not be a problem, but just be aware of it when you enter the conversation. Often it's a sign of, personality dynamics, really, as much as anything. More so than they're actually, they have some shifty source of funds, from some offshore oligarch. It's really more often like an ego and some distorted, personality approach to the way they make their investments. And that will express itself if you do take an investment from them and you end up working with them over many years and you hit those rough patches. So just a thing to be aware of, buyer beware. You're the buyer, you're, buying their funds with your equity. So again, may not be a problem. Do your diligence, get to know, who you're taking investment from, check references that they don't give you. Everyone always gives the good references, but just make a mental note. It's my recommendation. And then this is, again, the extreme opposite, where Henry here put his investment criteria on his LinkedIn profile. So making it as accessible as possible, so everyone knows what investments he's looking for, which is my preference. All right, so we've identified comparable companies. You've gotten some, investors who have invested in those, the other companies they invested in, the investors who invested in those companies and who their co-investors were. So you're starting to, get a sense of what you're searching for here. Now let's supercharge it a little bit. Get off of CB. Let's get into Cap IQ. Man, if there was a resource that could help me find buyers and investors and build a list, that would be handy. Oh man, CB Insights. What is this under targeting? You have a module called Find Investors. Let's check it out. So CB, S&P, Preqin, all of them, they aggregate information from the reg filings and from deal announcements. And then it's all about how they tag it and organize it. So really what you have here is a search function that goes through that same investment criteria that we just covered as far as identifying comparable companies. So you're going to tick through, industry, investment size, investment stage, seed, series A, series B, follow on. Was it debt? Was it a buyout? Was it a minority deal?
This was on CB?
No, we're now on S&P Cap IQ. So CB, I recommend getting the ball rolling, identifying comparable companies, on those market maps, the investors who are in them, their co-investors, other companies they invested in, the investors in those. That's going to get your ball rolling. And then you're going to start to get a sense of what the criteria are that, match up with you. Take that and let's move into S&P Cap IQ. That's really the most robust resource you have available. And then you're going to go to under screening, find investors. And we're going to go through this the search module where you're clicking on those criteria that we just covered. And what you're going to see here, you're narrowing down a funnel. So this is going to be iterative. You're going to change your criteria. You're going to do these searches over and over again. But you see here, you're starting out with a data set of 326,000 companies. And as you add narrowing criteria, you get down to 149 applicable transactions. So a transaction being an investment that was made in a company. You're going to go through that 149, and you're going to find some that, are applicable. You're going to find some that aren't. And then you're going to tweak your keywords. You're going to tweak your criteria, and you're going to do it again and again and again. You'll save the ones that were applicable. And I'm going to get into, what you should be saving. But they have a module there where you're able to build your list. Again, this is also how you build a comp list. So their valuation, the size of the investment, when it was made, so how aged it is, that'll all come up. But you do it over and over and over again. If you end up with a search that gives you 25 results, that's going to be inadequate. You're going to want to open it up. I do recommend going broad. And then if you're going through a big list and you're like, man, these companies are not applicable to me, that's a sign you have to narrow it. So it's a flexible, iterative process. But that's where you're going to get the transactions and find the investors. who are active. Again, you start to see the same names pop up. So again, investors invest on theme, they invest in sector, they invest in stage. So New Enterprise Associates comes up here a lot. Spark Capital comes up here a lot. Thrive Capital comes up here a lot. These are all comparable companies listed on the left. So you're going to see, oh man, investors are investing a lot of the comparable companies. And down in the bottom here, for Shinesty, Jay Hirsch shows up again, also listed just in the freaking database because they pulled it from the Reg D file. These are also ordered by deal size. So investors generally do have to deploy a minimum amount of capital. So investors that are cutting $50 million checks likely are not cutting $3 million checks unless they have two different funds set up specifically to do that. Part of the reason is an investment partner can only sit on so many boards. They can only monitor so many companies. You will find seed stage incubator type investment firms that have hundreds of investments. That means that they're not spending a whole heck of a lot of time with each one of those portfolio companies. When I was managing a portfolio, I'd say the biggest complaint that we got from our CEOs was they wanted us to spend more time with them. And our response was, we're spending as much time with you as we do with any of the other CEOs that we work with. We have a portfolio. So you get your allotment. So be aware of that. Market line, another, I'd say like magic tool that you have access to. So market line, not the greatest search function, doesn't really work the same as CapIQ where you put in all those criteria, but you can start with keywords and then select transactions. Once you identify, I'd say 3 transactions that are like super applicable to you, you're like, man, that company is like my company. That deal is the right sizes, the deal I'm looking for. They raise the same amount of money. I want to find more like these. MarketLine has a feature called Ask an Analyst. It's a button at the bottom of the page. You fill out the comment button. I recommend you include the 3 deals you identified. They'll each have a unique identifier where you can just put in, the name. And then you hit Ask an Analyst. That sends an email to aspiring MBA student in a basement in Chicago, who's then going to do that whole S&P CapIQ exercise that we just did. And in a week and a half, you'll get an email with a spreadsheet that we just went through how to compile. So you're all busy, CEOs are busy, everyone's busy. This is a free resource you have. You now have an analyst working for you in Chicago who can do this research for you. I don't recommend entirely outsourcing it. If you have no other choice, go for it. It's great. But this is a great way to kind of double your efforts. If you're also, quite frankly, doing this for a project and you do that, you're going to come out looking like an all-star. We're like, oh my goodness, he spent hundreds of hours on this work. Thank you, MarketLine analysts. So any questions on, those really are, I'd say, the 3 resources that I would highlight: MarketLine, CB, and CapIQ. As far as going through that iterative process of companies like my company who invested in those, what other companies did those investors invest in, who are their co-investors, and start building out a list of comparable investments and who the investors and the partners are. We're going to move into making contact, but before we do that, any questions on what we just covered, or comments?
What incentive do the MarketLine analysts have to do that analysis? That seems like pretty interesting.
Yeah, I mean, that's the job that they're hired to do. I'm sure they're trying to show that they're good at doing it in order to get a better job.
So they're like, but like the companies pay through ads or something. That's the business model.
I'm not sure. It's just in paid. It's included in the $100,000 fee that you pay for the license. Okay. Yeah. But again, like that's one of those things that when I found it, it felt like cheating. but you know, it's not cheating. It comes through the library. You're supposed to use the library. You know? All right, so the steps in making contact, what do investment bankers do? Why do people hire investment bankers? It's one of the base reasons is to get you in the room and have meaningful conversations with the right investors. You want to look for bankers. Startups don't hire investment bankers, but your company will be successful, and someday down the road, you'll have the enviable burden of having to deal with investment bankers. And when you do, you're going to want to look for ones that have done deals with and have good real connectivity and show real volumes of deal flow to the investors you're trying to get in front of. That's the currency, and it's that history of knowing these investors from experience is really what you're looking for, that they can actually open doors. Shy of that, there's a lot of cold calling, both to companies as well as to investors. So you cold calling is, kind of just as good at this stage. But there is a hierarchy. We talked about mapping your connections. Hey, do I go through I don't know this guy, but I can get to an attorney who can get me to him. I can go through the accountants or the bankers. I can go through the Swartz Center. So mapping your network to get to the investor that you've identified. There is a hierarchy of those introductions. So if you have multiple routes to take, you're going to want to go in this order. So a co-investor, particularly a multiple co-investor, is the highest quality introduction that you can get. That's why I spent so much time on, hey, CMU's made 92 investments. I think it's actually more than that now. Those 92 investors have 1,000 co-investors. Like that's your highest quality intro. That's the right place to start. The reason it's so high quality is because they have experience with each other. Other investors also provide a good housekeeping stamp of approval. It's like being in the club. If another investor makes the introduction, I'm going to think, okay, well, he's another investor. He's applicable. He knows like how this all works and generally what we're looking for. And there's a certain decorum, to follow. So another investor introduction. If I haven't actively co-invested with a person, I'm sure we have lots of overlap, and they're in the club. Your investors, again, they should be writing checks. They should be writing follow-on checks, and they should be bringing in other people to write checks. That's what they should be doing. So if they can provide intros, they should be industry leaders next. So they're not investors, but they're well respected in your industry, and they're probably well known. Investors have probably been calling on them in the past. And then, quite frankly, just picking up the phone. Get off the email, of course, send the email, but pick up the phone. You'd be surprised, especially while you are a student, what people are going to be willing, take your meetings, talk to you, quite frankly, say things that they would never say to you in a good way, disclose things if you weren't a student. So pick up the phone. It's a little bit of a superpower. I do find a lot of our peers are not willing to pick up the phone. They're scared of the phone. They want to stay on email. And there's just a superpower that comes with picking up the phone and getting people talking. Listen, let them talk. You'll be amazed at what people will say. And then finally, if you have no other options, investment bankers is what we do for a living. But again, I'm going to keep hammering this point. It's the responsibility of your investors and the board to be bringing in other checks. And if they're not cutting checks and bringing in other checks, they probably shouldn't be on your board. But ultimately, this all falls down on the CEO, who, by the way, is wearing 10 other hats. They're trying to run a company. So this comes back to another core reason why people hire investment bankers. If the CEO is spending all their time fundraising, they're not spending their time running the company, you're probably not going to hit your performance marks that allow you to raise money, which means you don't raise enough money, which means you're back on the trail raising more money not running your company, and you can end up in a little bit of a slow burn fundraising death spiral. See it a lot. So also highlights the point of this is very important, very helpful, valuable work that every single company in the Swartz Center and Project Olympus and Innovation Works needs. Because this is not, necessarily the highest best use of the CEO's time, but that's where this ultimately falls. Do recommend using a CRM. There's a lot of free ones available online.
What kind of things, you mentioned as a student, the investors might give valuable information to you that they wouldn't have given to other people. What, can you give us an example of something like that?
Yeah. So if you call an investor or you call a company owner who took an investment, say, hey, I'm working on this. It's like your company. Can you share your experience? They're much more likely, because you're a student, to be open and sharing the dynamics of the deal, what the valuation was, what the check sizes were, what the process was. People are real apt to share their successes, but what you don't often see are they might have had 3 failed deals fall apart before they closed. It might have actually taken 2.5 years instead of the 9 months that it looks like it took. People to stay away from. The most valuable advice I get as an investor are investors to not co-invest with. And that's not something that people give up very frequently. It's not good decorum. You don't want to, ever speak ill of someone else, but everyone's, any active investor sat on boards with people who they've had that experience, and they will never invest with that person ever again, no matter how good the company is. Lots of people will tell you, the great investors that they want to go invest with, that you should want to take money from. It's much more difficult, and you have to be in, a quieter setting. And as a student, it's kind of conducive to that, to finding out who to avoid. This is some examples, but that's a good question. And that part about who not to take money from, I would highlight. Other thing on the, everyone highlights their wins, but, not otherwise. Maybe my biggest personal investment miss was with a local company called Wombat. I was negotiating the valuation on their Series A. CEO wanted a valuation that would have required them to exit over $100 million. I couldn't find any comps to show that any had ever exited over $100 million. He didn't have any to offer me. Said, I can't underwrite a deal saying you're going to be the first one ever to, hit a valuation in this industry of that amount. And he said, well, Ben, I'm going to do it. So I didn't invest. He ended up exiting for over $300 million. Miss. Sent me a text, told you I was going to do it. But I did find out, I guess in consolation, it doesn't make up for actually missing the investment, but in a little bit of consolation, they had tried to exit the company at 50. A competitor sued them just to squirrel up the deal successfully. So the deal fell apart. So management said, shucks, we got to go back to building the company. And, they built it up and exited at 300. So it all worked out. I was almost right until I was wrong. That's how it goes. So back to like getting prepared to make contact. You've been pulling down all these comps. You're pulling down all these investors. You're getting all their contact information. Like, how are you accumulating it? I do recommend using a CRM. There's a bunch of free ones online. You don't have to pay for Salesforce. But at like the very base, all a CRM is a Rolodex, which you can keep in an Excel spreadsheet. So I'm going to show you what columns to have in your Excel spreadsheet. If you're not, going to use a CRM, these would be the fields you're going to use in your CRM. But other tip on all these conversations you're going to be having, ask for an introduction. So if someone says, man, I like your company a lot and I want to proceed, ask, who else should I be talking to? If they say, hey, great company, not a fit for us right now, ask, can you introduce me to 2 people that you do think this would be a good fit for? if they're sincere and they're saying you're not a fit, but you're an awesome company and they're sincere about it, they'll be pretty happy to provide those introductions. That gives them like reciprocity credit with other investors to send them deal flow in the future. And we just talked about getting referrals from other investors as a high quality introduction. If they're just being polite, they're going to be pretty coy about actually making those introductions. And this is a test to find out if they meant what they said. But always ask for introductions. Get a multiplier on your effort. You're already there having the conversation. Why not? So I'd pull out your camera and take a picture of this. This presentation will be available later, but just take a picture of this now. In addition to the librarian's contact information, this is the info that you want to collect on your spreadsheet of contact information for relevant deals. Investor name, category, growth investor, seed investor. You're going to see things that you're going to want right now and things you're going to want to save for later. Fund vintage year, that's when the fund was raised. So an old fund's going to have less dry powder, like we talked about, rather than a new fund's attractive. Record their investment criteria. You're going to want, we're going to touch on this, but you're going to want to reference that when you reach out. They're going to want to know that you looked at it. I highly encourage you to include comments or reason as to why you're including them on your list, even if it's just a couple words or one sentence. You're going to be doing this in fits and spurts, and you are not going to remember why you put someone on the list the day after you put them on the list. I find leaving these little comments, they're notes to yourself, to be super helpful. Our analysts do it. They find it super helpful. It's also helpful, when other people are reviewing your list. And then I grade them. So you can do A, B, C, A, B, C, F. When we conduct outreach, typically say you're going to want to go out to at least 100 investors. If you're going to, complete a fundraise, you want, ideally all 100 you would have graded A, like they're the best. Inevitably, you're going to run out of investors you thought were A's. You're going to have to dip into your B bucket. And ideally, you're going out to A's and B's. Occasionally, you're in a super niche, it's some sort of situation, and you're going to run out of B's. Dip into your C's. What you're doing here is you're prioritizing your effort, is really what you're doing to make the most of your time, get the biggest bang, for what you're doing. And then F's, I save the F's just to know that I looked at them. So if I see them again in the future, I don't have to go through the mental process of, screening them again. And then the recent deal that led you to them, we just did all that comp screening. You want to save that. You can actually include a link, if you maintain access to the database to go back to it. But investors like that also when you're conducting outreach. Say, hey, I saw you did this deal, a lot of similar dynamics. I've read your investment criteria, and I think you're going to want to look at my company. But these are the fields that you're going to want to fill out as you're going through this and you're accumulating all of these investors. This is going to be your Rolodex. So you now have your list. You have graded them. There's enough volume there. There's a balance between quality and volume. You earn the right to focus on quality with volume. So now you're ready to conduct outreach. What do you need to have in order to be prepared to do that? Well, you have your contact list. You're going to want a personalized intro. 3/4 of that intro text can be canned. You're going to repeat it over and over again. There's going to be a paragraph about your company. This is not a long letter, but again, you are going to want to highlight right up front, this is why I'm reaching out to you. Mutual contacts, again, state that you read the investment criteria and actually have read the investment criteria. Applicable deal, like what's going to separate you from the rest of the solicitations they get to show, okay, well, I'm going to invest the time to look at this one-page teaser is what we call it, a tear sheet. One-page summary of your company, the amount of money that you're raising, what the situation is, why you're raising the money, what's it for. You don't want to put anything that's confidential on this one pager, though. You should fully expect that it's going to travel the world far and wide. You need to include some, enough information that they're able to make a judgment call as to whether it's applicable to get on a phone call with you. So it may feel a little uncomfortable, but don't put anything on there that you wouldn't want floating around. You should fully expect that this, one page is going to float all over the place. If you get a response, your next step is to say, I'd like to set up a phone call. If they're local, go meet them for coffee. But you should be prepared with a short, less than 20 slides, pitch deck. There's a gazillion examples of good pitch decks on the internet, so I'm not going to cover that. But that is your next step. This outreach is in order to get them on the phone, get them in a meeting, give them something more than an elevator pitch. But you should expect you're going to have half an hour. This is a half-hour call, maybe schedule it for 45 minutes if you can. So only what you can get through in 20 minutes with a little bit of chit chat. So 20 minutes, that's less than 20 slides. That's the level of detail you're going into. If you get through that call and they're saying, hey, I'm still interested and I'm going to introduce you to a friend because you've asked me for an introduction. Now you need to have like your real detailed materials ready. So your business plan, your financials, if you have financials, your legal documents. These are early diligence materials. What you do not want to have happen is you've done all this work, you've conducted the outreach, you found the investor, he's a perfect match, he's excited about your company. He says, all right, I want to learn more. And you go, oh, well, can you wait like a few weeks? I got to go like get organized and get the material ready for your review. Womp womp. Ice cold, he's going to move on with his life. So it's important to get all those materials ready in advance. And once, you can do it a little bit in parallel, but once you're mostly organized and you have those early diligence documents ready and you have an ask and you have materials for them to review, that's when you start conducting outreach. So you don't end up in that situation of someone like, I'm excited to invest, like, give me the materials to review so I can cut a check. Oh, I'm not ready yet. Keep the momentum. A lot of this is built on momentum. That's the steps. Those are the resources. That's the information you need. Everyone needs it. Super valuable. It's not something that goes away. Companies of all sizes go through this, and it's the exact same exercise. Gets a little shorter with reps, but the steps don't change. Any questions on what we covered or anything specific to anyone's individual company they're working with?
So we've done due diligence. We've, found investors that we think that we should reach out to them. We have a coffee chat. At what point do you start strategizing if you're going to be fundraising? How much time should you, let's say, how many months should you allocate to fundraising, especially in the early stages?
A year. An early stage seed Series A fundraise, 9 months, but you should be prepared for it to take a year. And you should have enough cash that it can take a year and a half. Because the worst negotiating position to be in is that you're negotiating terms and an investor finds out that you're about to run out of cash and go out of business unless they hand you over their cash. Boy, did the leverage in the room just change if that happens. So you don't want to be at the negotiating table right about to run out of cash. So a seed Series A fundraise should last 9 months. It will often last a year, and you should have cash that will last you longer than that, so that you're not in a weak position right as you're trying to close your deal. Anyone intending to do some fundraising? Yeah. What the fantastic. And what type of company do you have? Fantastic. You guys might have some cross pollination. He's training social media stars. So good to know. And I would ask the Swartz Center. Scotty Ventures is a good source for undergrad students who are interested in this work. There's also an undergrad finance club. I used to only take MBAs, but I've actually found in recent years that I get a lot of great work out of the undergrads as well. So, don't ignore the undergrads. The MBA school is an excellent source, but the undergrads are practiced at research, and that's exactly what this is. Again, this is also what investment bankers do. Crosstree, we were having a phenomenal start to the year. Really, really robust deal flow. Healthcare, technology, pharma services, two incredible sectors to be in right now. We are beginning on-campus recruiting at Carnegie Mellon for our intern class in February, closing that out in April, I believe. This is for next year, not this upcoming summer. But there may be project work for people looking to get experience doing work similar to this in the meantime. So again, please reach out to me on LinkedIn. I'm going to leave some cards up front. Please take a card. Contact me anytime. Proud Tepper alumni. Always happy to help people out when I can. Thanks so much.